What is going on, everybody? This is S Trades, and today's day 24 of the bootcamp. And in this video, we're going to be going over my strategy, the long-awaited strategy that I've been hyping up for since the beginning of the bootcamp. So without further ado, let's get straight into the video. So what was the reason of me kind of delaying the strategy video all the way up until the very end is because I wanted you guys to understand all the concepts first and just have a basic understanding of what I'm going to be talking about in this video, right? All these terminologies that I'm going to be throwing at you guys. I don't want you guys to be fully confused and fully new to it, right? Because some of you guys might be experienced, some of you guys might be completely new, which is totally fine. And in order for you to guys get to this point in the video, in the bootcamp, you guys are already supposed to have somewhat of a good understanding of all the terminologies already written on the screen. So it's not going to be completely new to you guys, and you're not going to be just completely lost, watching the strategy video. So that's kind of the reason why I held it off till the very end. So yeah, without any more yapping, let's get straight to my strategy. Shout out to PB Trading. Those were my mentors before and kind of showed me the strategy, right? I added my own tweaks to it. And this strategy is very, very profitable. It's 70% win rate over the long term. I back tested this strategy for years and years of data, and it's proven to be working for many, many other people. So we have two kind of parts into the strategy. We have a mechanical strategy and we have a discretionary strategy, right? For the most part, they're kind of the same, but it's just for the difference when you're adding your own discretion into the strategy. So it would consist of you, for example, targeting something else rather than just like a mechanical, let's say 5-minute or 15-minute. And for mechanical, it's just strictly rule based. You don't even have to know the bias, right, for the day. You just kind of see it happen in front of you and be like, all right, I'm taking it. So that's kind of the mechanical strategy. And discretionary strategy is pretty much when you add the bias into it. You add kind of the daily direction for the stock or for whatever you guys are trading, right? And it just adds your own discretion into it, right? What does it consist of? Or the first very, very important, the most important thing of the strategy is it has to be rejecting off of a higher time frame PD array, or it has to sweep some sort of a higher time frame liquidity. That is the base of the strategy, right? I will never take a trade or even look for a trade if step one does not happen. This is literally where the whole strategy starts coming from, right? So you need some sort of a rejection off of a high time frame PD array, and a high time frame PD array is just any fair value gap above a 15-minute, right? It could be a 15-minute fair value gap, 30-minute, hourly, 4-hour, or even a daily fair value gap, right? So that is your high time frame PD array. For the other parts, you could also involve like breaker blocks, order blocks, but I don't really trade order blocks and breaker blocks. I just stick strictly to fair value gap. So in my terms of strategy, it's only the fair value gap. So anything above a 15-minute fair value gap would be considered as a high time frame PD array, and a high time frame liquidity sweep would be considered anything as previous session or previous day, so previous day high, previous day low. It could be London high, London low, Asia high, Asia low, right? And for sometimes, right, for the discretionary part of the strategy, it could also be like a very prominent high and low. So it could be like an hourly high and low that got formed at 8:30 or at 9 o'clock or 9:30 a.m., right? So those could also be involved, but that's more, again, a discretionary part of the strategy, right? So if I see like maybe a data high or data low get formed at 8:30 and that gets swept out, I'll consider that as a higher time frame liquidity if my bias and everything else kind of is aligning with the trade's direction. So that's the discretionary part of the strategy, right? And next step would be to actually look for the entry model. Would be you looking at high time frame inversion fair value gap, right? So I trade strictly inversion fair value gaps, right? I don't enter off of anything else but an inversion fair value gap. And a highest time frame inversion would be anything from 1 to 5 minutes, right? So it could be a 1-minute fair value gap, it could be a 2-minute, 3-minute, 4-minute, 5-minute, right? But it has to be the highest time frame in that leg, right? So what it means is if you're looking at a certain leg and you're trying to take longs, right, you have to go from the 5-minute down to the 1-minute, right? So let's say if you go on a 5-minute chart, you see that there's no 5 minutes in that leg, so there's no 5-minute. You come down to a 4-minute, look at 4-minute, there's no 4-minute, you come down to a 3-minute, there's nothing on a 3-minute, so on and so forth. And let's say you come on to a 2-minute and they have a 2-minute fair value gap. So that fair value gap is going to be your highest time frame inversion. So you have to wait until that 2-minute candle ends up closing above or below that fair value gap, and then that would be considered as the highest time frame inversion fair value gap, right? And also step 3, it has to be a singular fair value gap in the leg, right? So for example, if you take a quick look at over here, right, so let's say you're trying to take longs in this area, right, there has to be only a single fair value gap right here in this area, right? It cannot be a fair value gap over here, over here, over here, over here, and it just constantly like all around this entire leg. There's multiple fair value gaps. There's a 5 minute, 15 minute, 2 minute, 3 minute. It cannot be like that, right? So it has to be a singular fair value gap, right? So let's say there's a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, or let's say there's everything, right? You obviously wait for the 5 minute, but in terms of having a single fair value gap in the leg, it can't have like a 5 minute over here and right above it be a 15 minute, or even inside of a 15 minute. So anything above a 5 minute would not be considered as a mechanical or discretionary model and an entry either, right? So you would need a singular fair value gap. Anything, so if it, like I said, this might be a little confusing, but if there's a 5 minute, right, and there's a 4 minute, 3 minute, 2 minute, 1 minute, all in the same area, that's fine, right? You just take the highest time frame, which would be the 5 minute. But if there's, again, a 5 minute and right above it there's a 15 minute, or we're inside of a 15 minute, so there's no longer a singular fair value gap in the leg, right? So now as for the targets, right, we're going to be targeting unfilled fair value gaps and liquidity levels, right? So unfilled fair value gaps, it's anywhere from 5 minute, 15 minute, 30 minute and above, right? So it could be a 5 minute, it could be a 15, 30, it could be an hour, it could be even a 4 hour fair value gap, right? And liquidity levels is just pretty much any prominent swing highs and swing lows, right? So it could be, again, maybe London high, London low. It could be a previous day high, previous day low. It could be, you know, an 8:30 high, 9:30 high, 9:30 low, you know, or even like an hourly prominent high and low, right? So that's that, and it has to be an unfilled, right? Meaning that it has not got touched. So let's say there's a fair value gap in this area right here, right? There's 15 minute over here. It has not got touched before, right? It can't have something like this right before that. No, it has to be untouched. It cannot be traded into that level and then kind of came down. That would not count as an unfilled fair value gap anymore, right? So that is that. And now as for the actual entry, like I said, you enter off of an inversion, right? So where would you place your stop loss, right? Your stop loss would be at a swing high or swing low, or if, let's say, the trade is a little bit higher than what you want it to be and it's like very bad for your risk to reward, you could also put it at this the body closures, right? So if you're taking a long, right, you're gonna put your stop loss at the open of the candle. So like there's a fair value gap in this leg that got inverse, right? You would put it somewhere all the way over here, but obviously putting it at the swing high and swing low would be the safest option. So either adjust your risk accordingly, or have, if you're like very, very confident on a trade, right, you could also just put it at the swing body. And again, I'll show you guys examples later so you guys have a better understanding. And as for the rules, you'll pretty much just break even at 1-to-1, or if you get tapped into a unfilled gap, or if you take out some sort of an internal high and low. So in this case, right, for this trade, you're targeting, your main target is this Asia high, right? For the difference between MEC and the discretionary strategy, the MEC model will just be you taking this trade to this 15 minute or the 5 minute, right? That would be the MEC, right? You have a high time frame PDRA get tapped into, right? You get your highest time frame inversion, and all you're targeting is the unfilled fair value gap, and that is the MEC model, right? But let's say if you're really, really bullish on the day and you want to, you know, have a strong bias towards even higher prices, right? So you could be targeting Asia highs, right? So in this case, right, let's say this is Asia high. Would be now discretionary, because you are hoping, or you are thinking that the trade will be going up higher past this 15 minute, right? But once the trade ends up hitting the 15 minute, or let's say if there's like a 5 minute a little bit below over here, or let's say there's like a very prominent internal high or internal low, you would then go break even once that level gets hit, and then, you know, manage your position accordingly, right? So then if you're only taking a MEC model, you would fully exit at the 15 minute. But if you're discretionary on that day and you wanted to trade up to the Asia high, then you take a partial at the 15 minute and then hold the rest to Asia high, right? Quick rundown of the strategy, right? You need some sort of a highest time frame PDRA, right? So in this case, right, let's say you are bullish on the day, so you want prices to come down lower to tap into some higher time frame PDRA. And in this case, right, we're kind of trading down, right? And another thing is, it doesn't have to both do the highest time frame PDRA and sweep the highest time frame liquidity, right? It could do one or the other, or if it does both, then that's even a better rating for that specific trade. So in this scenario, let's say we're coming down, or let's say we take out a London low, and then we also tap into some sort of an hourly fair value gap in that leg, right? And let's say it's discounted or whatever. So then once you tap into that hourly and you're bullish on a day, right, now you start to see, are there any unfilled fair value gaps in this leg, and is there any like some very important liquidity levels that you could be possibly targeting, right? Once you do see, okay, there's an unfilled 15 minute, there's also an Asia high above us that is very, very easy draw on liquidity for the day, you now look at your entry model, right? You start to see, okay, where are all my fair value gaps in this leg that ended up coming down to this 1 hourly, right? So you're looking at the leg that traded into that highest time frame PDA, right? So in this area right here, you're going to be looking at any fair value gaps from a 5 minute to 1 minute, right? So let's say in this case, it's like a 3 minute was the highest time frame fair value gap. So then you go on that 3 minute chart and you wait until that 3 minute ends up closing above this fair value gap, right? So the moment that body gets closed above that inversion, then you enter on that 3 minute, right? You set your stops either on the internal or the body closure of that candle, and then you're targeting either the 15 if you're only doing the MEC model, and you could possibly target the Asia high if you're discretionary on that day, right? And let's take a look at a bearish example, right? Same scenario, right? If you're bearish on the day, you want price to come up higher, right, into some sort of a key level. And in this case, let's say we took out a previous day high and we tapped into the 15-minute fair value gap. Again, it doesn't have to do both, right? It's fine if it only swept the previous day high, and it's fine if it only traded into the 15-minute fair value gap, right? And then once that happens, you're now looking if there's unfilled fair value gaps and if there's an obvious draw on liquidity. In this case, we have a 5-minute fair value gap and we have a previous day low. In this case, right, it could also be London low. It could also be a 30-minute. It could be an hourly fair value gap. It could be 4-hour fair value gap, right? So once you see that those are unfilled, then you would look at your entry model. Again, we have entry model anywhere in this area because this is the leg that got traded into that PD array. So once we trade into that PD array, you'll be like, all right, we have, what do we have, right? We either have a 5-minute, 4-minute, 3-minute, 2-minute, 1 minute. And let's say in this case, the highest time frame is the 4-minute, right? You go on that 4-minute time frame and you wait until the 4-minute body ends up closing below that fair value gap. And the moment it does, you take the short, set your stops to the swing high or the body, targeting the 5-minute if you're just doing the MEC model. And if you're discretionary and you're very, very bearish on the day and you want to target more, you would be targeting the previous day's low, right? So that's about it for the strategy. I'll go into some other minor details in a second, but another thing that I wanted to mention is, you know, if you're just taking a one-on-one MEC model, the MEC model is what's very, very, very high win rate, because you're always targeting between different PD arrays, right? Price always jumps from one PD array to another, right? So that is why the MEC model is very, very high win rate, because you're not shooting for the stars all the time. You're just, for the most part, the MEC models would be somewhere from 1 to 1, sometimes to 1 to 2, right? Risk to reward. And people that always, you know, hate on 1-to-1s, I don't understand why is that, right? If you're always taking 1-to-1 and you have a high win rate, like in my opinion, high win rate would be a lot better than a high risk to reward, because yes, you're going to be getting those big wins, but I'd rather consistently win more rather than lose more and then just get that one big win that's, you know, erases my losses. That's just kind of in my opinion, which is why this strategy makes sense to me, because I don't want to lose more. Instead, I want to win more, and it doesn't have to be crazy big days, because I'd rather just be more consistent and win more rather than, you know, lose and look for something like 1-to-12 or 1-to-10 risk to reward, you know what I mean? So if you only take MEC models, that's perfectly fine, right? It would be like this. Nothing wrong with that, right? Your win rate will be super high, and for the most part, you're always going to be winning. Not always, but the win is going to be really high, right? But then once we start kind of adding a little bit of discretion to it, right? If you're targeting the previous day's high, previous day low, right? We're targeting somewhere past the unfilled fair value gaps. Sometimes you would get break even on the rest of your positions, because once the price kind of taps into those unfilled fair value gaps, most of the time they would get a reaction from them, because they're very prominent, very important levels, right? So that is why you kind of have to just play around with the strategy and see which times are you going to be more discretionary, where do you only want to be mechanical in this case, right? Mechanical is super easy, right? You have all of these rules, right? Follow those rules. The mechanical trades are always going to be there. Discretionary, however, you know, you're kind of targeting, you're kind of pushing your risk to reward a little bit more, and your win rate might be a little bit lower than the MEC model, right? Because you're kind of looking for the highest prices that you can get in that level. But then again, that's if you're really bullish or really bearish on the day. Another few rules that are important to mention is not to be trading against SMTs, right? And in this case, what that would mean is if you're trading the NQ and you're also watching the ES, right? If ES ends up kind of taking out one of these levels, let's say if you're in this long over here and price is coming up higher, let's say taking on the 15-minute, and we're kind of trailing to the Asia high, right? And you see that ES ends up taking Asia high and NQ doesn't, which means it created the SMT. And a lot of times in those scenarios, the SMT will hold and you want to close that trade early, right? So that's a very, very important thing to keep in notice, that if you see an SMT, do not trade against it. For the most time, they're gonna get you break even. And yeah, so do not trade against SMTs. I mean, again, you could always ignore them if you're very, very obvious on your draw on liquidity. So let's say if we hit that 15-minute on ES and you're still super confident on that draw on liquidity that we're going to go up higher, then you could hold it against SMT. But if it's just like a quick mech model, right, do not trade against SMTs. And another thing that not to trade against is equal highs and equal lows. And so I don't want to see equal lows at my longs, and I don't want to see equal highs at my shorts, right? So what do I mean by that? I do not want to see something like this, right? If we have an equal low that's spread apart, let's say this happened like, I don't know, 15 minutes ago, 30 minutes ago, and then we kind of came down, made an obvious equal low at like a very prominent area. I don't want to take longs in that area. I want to see until price kind of comes down, takes out that equal low, and then I'll end up taking that trade. Same thing with the bearish example, right? I do not want to take a trade if price kind of comes up, making a very, very obvious equal high at a very important level, and let's say we're like 15 or 30 minutes apart. I'm not really paying attention to those equal highs and equals that are right next to each other, but more kind of towards the equal highs and equal lows are kind of apart from each other, right? So like something like this, I would not short against, because most likely I'm going to get stopped out, and I want to see that get stopped out first, get that liquidity sweep, and then I will take that trade. Also, another thing to keep in mind, right, when you have multiple fair value gaps in the leg, right, for what I would be doing, let's say if like we have a 1 minute over here, and then right above us we have a 2 minute, and then right above us we have a 3 minute, right, instead of waiting for all of that to get inversed and then the risk to reward is completely dookie, right? Let's say if we inverse it over here right next to the 15 minute, right, I'm not gonna obviously take that trade because risk to reward will be super negative, right? I'm not gonna enter like over here, set my stops all the way over here just for like some tiny profit. What I would do in those cases is wait until price does an internal resweep, right? So if price kind of comes down, right, inverses that 1 minute and then inverses the 2 minute, but then taps into the 3 minute, and then it kind of starts to go a little bit lower. If we get that internal sweep, right, we sweep that internal low, and then we get that inversion, then that would be even a better trade. That would be like A++ trade, because now we did an internal sweep, right? And then my risk to reward obviously will be better, right? I'll take my entry over here, still targeting the 15 minute, the Asia high, right? As long as that those highest time frame unfilled 5 minutes or whatever, or liquidity levels did not get hit, right? So if they didn't get hit and we're trading in multiple singular fair value gaps in the leg, then I would wait for price to resweep my internal level, and it would be even more A+. If like there's a SMT in here, right? If there's SMT in my internal and it tapped into a very prominent low, A+ setup, I would take it any day. And a lot of the times also what price would do, if you are taking a trade and let's say price kind of ended up inversing that fair value gap too low or too high for your entry, right, what sometimes price would do, it would kind of retrace back to another smaller time frame fair value gap, or it would just retrace back to that inversion, and then you could either set a limit at that inversion, or you could set a limit at some sort of a fair value gap in the leg, or even go down on a lower time frame, even like a 30-second, let's say, and take that inversion lower. So let's say in this case, right, price kind of inverted all the way down here. The risk to reward is not so good, right? And then we created, let's say, maybe a 5 minute fair value gap in this leg right next to that inversion fair value gap. Most of the time price would kind of come up and tap into that 5 minute and that inversion that you just got. And then what I would do is I would take another smaller entry in maybe, let's say, a 30-second in this leg, right? And then I would put my stops above that 5 minute fair value gap body, and I would obviously I would target the 5 minute and the previous day low if I'm discretionary, right? So those are pretty much all the rules and everything that you need to know for this strategy. And now I could be showing you guys some of the examples on the real charts. Okay, so for our first example, we have this beautiful mech short that also was discretionary, so you could show both parts of the strategy in this one example, right? So if you go on a higher time frame, right, so if you go on a higher time frame, we have this 30-minute fair value gap over here that's in the premium, right, which is very likely to get traded into, right? And we could also add other confluences to it, like the fib, right? So if you also draw out the fib, right, this aligns with the equilibrium and the 0.618 level, which is again part of my other bootcamp videos that I showed you guys, right? So it aligns with a lot of stuff, right? So we have That 30-minute is our highest time frame PD rate that got traded into, right? As for our targets, we have this 15-minute fair value gap that was untraded, right? And another 15-minute over here that was untraded. So they're both unfilled fair value gaps. And now most of our criteria are getting met. We have our unfilled fair value gap, and we have our highest time frame PD rate that got tapped into. We also took out this data high from 830. Again, it's a very, very high confluence. And now all we gotta do is just look for the actual entry model, right? So if you go over here, right, now you could just scale from the 5 minute down to the 4 minute to the 1 minute and see where are the entries. So if you look at the 4 minute, there's nothing, right? If you look at a 3 minute, now we see that the fair value gap gets formed, right? Boom, it closes. And you can now take that trade at that 3 minute close, right? And set your stops at this candle, or you could be safe and put it over here, but this would suffice because this is just a very obvious point of the trade. If it goes up here, then it would be very invalid. So I set a stop over there, right? For the mechanical trade, it would be just for price to trade down here for this 15 minute, right? So it'd be 1 to 1.5, and that is a very, very good trade, right? And you could just simply keep it at that. But let's say if you're very, very bearish on this day, you could keep it now to a discretionary trade, and you could now could potentially hold down for this level right over here, which is the next 15 minute and a very obvious low. So if you just take a look at how the trade plays out, right, bang, we hit that 15 minute over here, right? The moment we hit this 15 minute, our stops would go break even. So now there's a risk-free trade. And if this is a mech model, you would just take out full of your position. But if this is discretionary, you would take some partials over here, and then you would pretty much hold the rest down to the other 15 minute. And now price ended up coming down even lower than that. But this is simply how I would play this trade right here. So taking a look at another example, right? We have this trading leg. We have a discount at 15 minute, right? Same exact scenario, right? We drove our fib. From down to here, right, you see that this 15 minute would be in the equilibrium level and the 0.618 level, so that would be a very obvious draw for us to have as a high time frame PD rate. So I'll mark that out, right? And if you even go on a lower time frame, we see that we have very, very obvious equal lows for potential discretionary trade if you are very, very bearish on this day. And so now I'm looking for shorts, and once we kind of tap into this 15 minute leg, now I want to come down and see the highest time frame inversion in this leg, right? So if you start looking, right, 5 minute, there's no 5 minute, 4 minute, no 4 minute, 3 minute, no 3 minute, 2 minute, no 2 minute, 1 minute. Okay, so 1 minute would be the highest time frame in this leg, right? So what you would do is you would mark out that 1 minute, and now you're going to look if we have any PD rates in this leg. We have this 5 minute, right? And there's no 15 minute, but yeah, there's no 15 minutes. So this 5 minute could act as just a simple quick mech model, right? So you go down on your 1 minute, since that's the highest time frame, right? You could just simply take this 1 minute inversion down to this 5 minute, have a quick mech model, and that's it. Call it a day, right? So let's see how that plays out. We inverse that 1 minute, you enter off of it, and bang, the moment that 5 minute gets hit, you see you have a big candle reaction to it, right? And we also have these equal highs over here, as you guys could see at that inversion, right? So let's say a few scenarios that could happen here, right? Let's say if you do not like this risk to reward, let's say this 1 minute inverse and you didn't really like that close, you could just simply set a limit down at this inversion, right? So you can get a better risk to reward in this case, right? And you could see that price ended up retracing back up to that inversion, so you could have entered over there instead of on the close, right? And but I was always kind of entering off of the markets, because with inversions, once the body ends up closing below or above that fair value gap, price usually kind of flushes or just skyrockets super fast, right? So not every single time price would retrace back to the inversion, but in this case it did. You could have get your better risk to reward in this scenario, right? Stop at that swing high, or you could even put it down over here, but just to be safe, it's only 2-3 points. I would put it up at that swing high, targeting the 5 minute, right? That's for mech model, right? But we have this very obvious equal low, right? You see how these equal lows are separate. They're not right next to each other, but they're separate. So this would be a very obvious draw on liquidity that's now acting as a discretionary model, right? So let's see kind of what happens here, right? We come up, we take out that equal high, we also make another equal high over here. But if you are very bearish and discretionary, you could just still hold that trade through, and only let's see what happens here. Price kind of comes back down, right? starts chopping up a little bit, and we see that price is going down slowly and slowly, and eventually we hit that equal low. So bang, right? So we hit that equal low, and this got retraced to another 15-minute. You could have had a 30-second entry over here, again targeting this equal low if you're discretionary, very, very bearish, right? But in this scenario, right, if you are very bearish and you had this discretionary trade, instead of getting that mech model, right, for over here 28 points, you could have got almost 100 points on this trade. But this is again if you're very, very bearish, and you would have had to be in this trade for like almost 2 hours. So you know, that just kind of depends on the day, and it depends on how strong your drawing liquidities are, and if you're very, very bearish, and if you think that this equal low is going to get hit. So if you did think that, you could have entered in the discretionary model in this case, right, targeted this equal low and did that. But if not, mech model is also fine. Just, you know, you could have run a little bit heavier risk in this scenario, right? Take that trade, get your 1-to-1 real quick, and you're done for the day. All right, so taking a look at another example, right? This happened right after this trade, actually. So we took out that equal low. We tapped into this 15-minute on the left to us, right? And we left this 5-minute, and we left these relative equal highs over here that are very, very obvious draws in liquidity, right? So once we left that 5-minute as a target and potentially these two internal highs, now we kind of just want to go down and start to see what's the highest time frame inversion in this leg. And in this case, this was a 2-minute leg over here, right? So what you could have done is waited until that 2-minute gets closed, right? So bang, we have that 2-minute ends up closing because that's the highest time frame inversion in this leg. So once that happens, you enter that trade, set your stops below this wick, right, and targeting this 5-minute if you only want to do a quick mech model, right? And that'll be exactly 1-to-1 risk to reward, which is totally fine. There's nothing wrong with 1-to-1s, right? Another thing that you could do like a consequent encroachment of the wick, right? Let's say you could have set it to like 0.79 or 0.618 of the wick, but I don't usually do that often. I just, you know, keep it straight to the wick. That's about it. Like if you guys use consequent encroachments, you guys could do that, but I don't use them much, so I just put it to the swing low, right? Entry at that 2-minute, targeting this 5-minute if it's only mech. And if it's discretionary, right, I would want to see this this high get taken and potentially this high, right, if I'm really, really bullish on this day. So let's see what happens, right? So as you guys can see, the moment we do this, right, so bam, price jumps up right away. See, this is kind of what I mean with these inversions, right? Whenever price closes above like a V-shaped recovery, right, that's what you want to see with inversions. You don't want to see these like slow kind of closures above those fair value gaps or below the fair value gaps. You want to see like immediate reactions, like 1 to 2 candles, and needs to close above or below a certain fair value gap. That's what you want to see. You don't want to see it kind of go slowly, like taking 10, 15, or 20 candles to close that fair value gap. That's not valid anymore. That's when you add your little bit of discretion and experience. So in this scenario, you have this 2-minute and literally one candle. That's all it took, straight V recovery, right? So if you're in discretionary, very, really bullish in this scenario, right, you could have taken partials, or taken full profits over here. Or if let's say you want to target this or a quick mech model, right? So you have 3 options in this case, right? So the mech model ended up working, right? And now let's see if this final TP would get hit. So what would you do in this scenario? You would set your stops to break even right after that 5-minute gets hit. And looking at what price does here, as you guys can see, we come down very, very close to our break even, right? And let's see if we hit that final TP. And bang, we eventually hit it, right? So as you guys can see, these are the difference between the mech model and the discretionary model. You guys see that the mech model, you're always in and out super quickly, usually for the most part, right? You see that 2-minute gets closed, price just shoots up, right? And you could have gone out right there in like literally 2 minutes, right? But now if you want to hold all the way up here for this obvious drawn liquidity, this prominent 15-minute high, right, you would have had to wait, again, you had to wait 2 hours for this trade to happen, right? But the difference is, again, this is 78 points, so you could have got 80 points from this, or you could have got 23, right? So this is the difference. Again, discretionary trades also come with more experience, so I wouldn't suggest you just going straight up with the discretionary model all the time. I would just stick to the mech model first once you kind of get a good idea of how the mech model works, and you start to see good results, then I would kind of start slowly looking into the discretionary strategy also, where you could, start taking profits at higher TPs and higher obvious draws on liquidity, right? But that takes time, that takes a little more experience. So yeah, that's that. I showed you guys 3 examples, and I don't want to make this video any longer than it is, because it's going to be a pretty long video already. So if you guys want to know more about this strategy, because there are still other factors that I could not possibly fit all in this one video, or else it would be like an hour long or something. So if you guys want to know even more in details about the strategy and little tips and tricks about how to increase your win rate, and how to not get break even and things like that, join up my Discord. I will be hosting a lot of calls in there and showing more detailed videos on my strategy there. But as of now, that's kind of the strategy that I trade. This is the strategy that got me multiple payouts, and not only my mentors, but their whole Discord and a lot of other people that seen super great results with that strategy. Again, if you guys don't know, it's 70% win rate. And yeah, that's about it for this video, guys. If you have any questions, comment down below. Put a thumbs up for this video if you guys enjoyed this video, and join up my Discord again if you guys want to go into more details with the strategy and ask any questions that I might have not addressed in this video. And yeah, I will see you guys in the next video.